morning we have started with treasury transactions, treasury management, and these are all the areas which we have covered. First, we have discussed about the difference or the comparison between conventional treasury and integrated treasury. Now it is a combination or it's integration of three sections or three departments. Earlier were handled separately. One is the funds department or liquidity management. Next is the foreign exchange department. And third is the security department. So these three were merged together and that function under one roof, and we call it integrated treasury. And then we have discussed about what is globalization and what are the impacts of globalization. Then then we have see IT integrated treasury as a profit center. Earlier, the conventional treasury or the treasury department of every bank was acting as a service center. Service center means they just undertake the requirement of the customers and the request of the branches. And but now, so therefore, it was a service center. It was doing a service, and profit was not a motive. But then the situation changed. Now the bank look at every transaction with a profitability angle, and therefore the integrated treasury also changed its objective, and they started generating profit. For generating profit, they have to do, apart from the conventional transactions, they have to go for contemporary operations also. So the conventional transaction means they does on behalf of their clients. When a customer may be an exporter, or he can be an importer, or he can be an NRI, and they comes to you means to the bank and request either for buying foreign exchange or selling foreign exchange or remitting foreign exchange like that, or for investment or security and all other aspects. So then that was the profit generated out of that transaction was very minimal. But subsequently, since all the functions or all the operations has to be viewed in a profitability angle, integrated treasury or the treasury department also started doing other operations, means connected to the treasury operations. They started doing the trading operation. Trading operation means then only they'll get huge profit. They started doing huge volume transaction. They just buy and sell it and get a profit out of it. It can be security, it can be foreign currency, or it can be borrowing and lending of money. Then we have discussed about organization of treasury. There are, this is kind of divided into three offices: front office, back office, and mid office. Then we have discussed about money market products. Money, what are the call money? Who are the participants in the call money market? Then it's a pure interbank market, and then notice money, term money, what those things we have discussed. Then we have discussed about the treasury products. Mainly, what are the treasury products? We have discussed about the money market products, because foreign exchange products already we have learned, because it is spot, swap, then forwards and like that. But then we have learned about treasury bill, then cash management bill, commercial paper, certificate of deposit, repo transaction, reverse repo, then CBLO, etc. Then security market products, that is debentures, bonds, and equities. Then domestic global market, ADR, GDR, ECB, EFC, LRS, liberalized remittance schemes. Those things also we have learned to some extent. Then we have moved to the third chapter, that is money supply, M1, the component of M1, M2, and M3. M1 is called the narrow money, and M3 is the broad money, which consists of the circular currency in circulation. M3 consists of currency in circulation, the term deposit, the demand deposit, and the post office savings deposit. All money equivalent put together. Then CRR and SLR, probably you can expect a question from CRR and SLR, a question from treasury products, another question from security market, or you can, these 2-3 chapters, you can expect some 3 to 5-6 marks question. Payment and settlement system, NEFT, RTGS, there is no issue. FX Clear, I have told. What is FX Clear? It's an electronic platform devised by CCIL for putting through the foreign exchange transaction. Then a negotiated dealing system and DVP. What is DVP? DVP is delivery versus payment. That means the delivery and payment happens together, means happens simultaneously. That means I told you the government securities, means the gilts. the treasury bill and other government securities, government bond and other things, that will be finding a place in the SGL of Reserve Bank of India. SGL means it is the subsidiary general ledger. So in the subsidiary general ledger, suppose Bank of Baroda is selling through repo, they are selling their security to State Bank of India. What actually physical movement doesn't happens there, because all the securities are in the demat form or in the electronic form. And what State Bank of India does, if they are Bank of Baroda is selling security and taking money from State Bank of India or from say Reserve Bank of India, what they will do, in the security portfolio, Bank of Baroda's account will be debited, and that security will be credited to State Bank of India's account. Like that. That is the system. And the money they will debit from SBI account and credit to Bank of Baroda. That is a procedure. So it happens simultaneously, just like our RTGS. That is what we call DVP, delivery versus payment. The delivery and payment happens together. They need not wait for some time, because immediately the money will be credited. Immediately the security also will be debited and credited. Who is selling, that account will be debited, and who is buying it, that account, the security will be credited. Similarly, who is buying the security, the money will be debited from that bank's account, it will be credited to the bank which is selling the security. And here it is repo. Repo stands for repurchase option. That means there is an undertaking that they will purchase it subsequently, and depending upon the requirement of that bank who is undertaking this repo operations. Then we have discussed about what happens in repo and what happens in reverse repo. A repo transaction, when RBI conduct a repo transaction, that means money is pumped into the market, means there is an infusion of security, money, liquidity. And in the case of reverse repo, it is an absorption. The excess money lying in the banking sector in the market will be taken by Reserve Bank of India and it will be deposited there. So then it is absorption. Or one is expansion, the other one is contraction, you can say, or infusion and absorption. Any word you can use. So frequently they used to ask a question on that. We'll move on to the today's topic. This session, I would like to cover on risk management. Again, this risk management, Mohanty sir might have taken, and you all must be having some idea of what is meant by risk management and how it affects treasury operations, that we are going to look into in this session. Okay. Now, treasury, earlier it was a profit center, service center, means it was managing only the liquidity or the funds. Subsequently, after globalization, it moved into profit center. Now, profit center, they have to, this when it happened after globalization or after the introduction of LPG, liberalization, privatization, and globalization that took place in Indian economic field, the economic market during the late 90s, when Manmohan Singh became the finance minister of India. Okay, at center. Now, to earn the profit, the integrated treasury has to deal in all the three markets. This all we have discussed in the morning: foreign exchange market, money market, and security market. Now here we are discussing about the risk. Market risk is present everywhere because treasury operates in the market. The major profit of the treasury operations derive out of the market fluctuations. That means they buy a security or a foreign exchange and they sell it at a higher rate. Why does this happen? Because of the fluctuation that take place in the market. So market risk is present at every stage. Profits are generated out of the market opportunities, and treasury is responsible for balance sheet management also. So with this background, we will go to what are the risks, or why treasury operations are risky. See some here, let me minimize this. Yes, risk refers to happening of an unplanned event with financial consequences resulting in a loss or a reduction in earning. This is the definition of risk. You might have heard this several times from my side as well as from Mohanty sir. So what is risk? If something happens, see, you are driving a vehicle. So suppose in between you are going to your office, in between suppose an accident happened. So it's an unplanned event. See, suddenly something happened. And if something happened, it may hurt you or it may have damage to the vehicle. So then you are incurring a loss. Same thing. You somebody, but in the financial sector, this risk means it is something which result in either a loss or a reduction in earnings. So that way, because in the financial sector, we term risk as happening of an unplanned event. And see, you never expected such a thing happen. Now you look at about this pandemic, COVID-19, lot of business institutions, they were running in heavy loss. Any sector, you take any sector, it can be agriculture, it can be industry, it can be tourism, it can be hospital, every sector, bank, everywhere. This is because nobody expected such a pandemic that is affecting all over the world. So this is a risk. Because of this is a market risk. What is happening? The spread of pandemic is affecting each and every one. Our mobility, we cannot move around. It affects our income. Only those people who are earning from a government department might not be affected to some extent, but for all others who are doing in any sort of business or any other activity, it is affected. So therefore, risk means it happens when something happened which was not expected of, will end up in a loss or a reduction in earning. Now, why treasury operations are risky? These are all the 5 major reasons. Number 1, highly leveraged transaction. You know what is highly leveraged transaction? Because with the low funding, you can do huge business. Suppose you have only 1 lakh capital with you. You can put through a transaction of even 1 crore, 10 times of it, 100 times of it. So the low funding is required. Whereas in the case of a credit, suppose you are considering a housing loan or a vehicle loan. If you're giving a vehicle loan to a person for 10 lakh, you need to give him 10 lakh. Then only that advanced disbursement will be completed. Whereas in the case of treasury operations, that doesn't happen most of the time. Because suppose you want to buy a security, or you want to buy a foreign currency, what the bank does, they place the order, they buy it. They buy it and they look, because this is meant for, I am talking of trading operations. Whereas if it is a merchant transaction, that means a customer is requesting you, I want to buy or I want to sell. Then this doesn't happen there. Then you have to really go for buy it and hold it, or you have to go for sell and other things. But when a bank is doing a trading transaction, other than a merchant transaction, they require only low funding because they are not holding it. They buy it, wait for some time, and when the price improves, they just dispose it off. So it is a highly leveraged transaction. So that is happening because suppose the capital of a bank is 100 crores, they may enter into a transaction with 1,000 crore. And suppose it end up in a loss, the loss will be heavy. So it is highly leveraged transaction. So that is one of the major reasons why treasury operations are risky. Number 2, finally the decision is taken by a single person, the sole discretion of the treasurer or the dealer. Now look at a credit. You see, when somebody is coming to a borrower is requesting, you would like to take a loan, he will come to the branch, he will request the credit officer, okay, or he will straight away go to the manager, discuss, I want 5 crore or I want 100 crore credit facility. Does the manager have the power? If it is a general manager rank branch, then only he may have the power of disbursing a loan of 100 crores or so. Otherwise, for a loan, normally the manager will have a discretion of maximum of 50 lakh or 1 crore, depending upon each branch. That's a discretionary power. Then to consider that proposal, he has to refer it to his higher authorities. So many persons will be looking into that proposal. So when a proposal is, even a manager is having a discretionary power of 1 crore, the proposal has to go to the concerned desk. The clerk has to put up a note. Then the concerned officer dealing the department has to verify all the ratios. You must be knowing in balance sheet, they will analyze the balance sheets, all the ratios, current ratio, quick ratio, DSCR, all those aspects they will learn. What's the capital? All those aspects they will look into, and he will put up his comment. And then subsequently, with this recommendation, suppose at that stage, the credit officer is giving an adverse remark. See, this is not worthy. The customer has got, his CIBIL score is very poor, or he has taken a lot of other commitments. Such case, they will put a negative note and then loan will be rejected. Therefore, sole discretion of the treasurer or dealer. So the dealer can decide whether to go for the transaction or not. And if the decision taken by the treasurer, the single person, can be wrong on a later date. Therefore, the risk is huge. Then confirmed and irrevocable transaction. That means when a transaction is put through, they cannot reverse it. Once the transaction is confirmed, they have to mean, suppose they said, I will buy 1 crore USD at 71 rupees. Transaction confirmed means they cannot go back. They have to buy. Or a dealer will say, I will sell this so much security. So confirmed and irrevocable transactions, then high value transactions. That means morning also I told you, minimum size of the transaction will be 5 crore and losses materialize in a very short term. Within a day, see a day, suppose in the morning, a dealer, they purchases say 1 crore USD at 71 rupees, thinking that the price will improve in the afternoon. And suppose in the afternoon, the price has not increased. Instead, it has come down to 69 rupees. What happens to the dealer? They have to dispose. They cannot hold it because each bank has given a discretion. This much only you can have the open position. So at 69, he may have to dispose it off. Then in 1 hour or 2 hours time, what will be the loss? For 1 crore USD, 1 rupee per transaction means 1 crore is losing. So that's it. The losses materialize in a very short term. So these are all the reasons why treasury operations are risky. Now, therefore, because prevention is better than cure, always all banks, they have some preventive measures to mitigate the risk. And what are the preventive measures to manage the risk? These are all the preventive measures adopted by various banks, all the banks. One is organizational control, second is exposure ceiling, and third is internal control. And organizational control, I told you, the treasury is divided into 3, and all the 3 are functioning independently: front office, mid office, back office, and they are also checking, they are giving information to the top management. And because of this is functioning in 3 different headed by 3 different people, the chances of committing some error or mistake or some adjustment are very, very rare. So that is one measure for preventing the risk, that is organizational control. Second is exposure ceiling. Exposure ceiling means every bank fixes the limit for counterparties. Means suppose State Bank of India, they fixes certain limits. What is the maximum they can have transaction exposure with other bank, with other financial institution, with mutual fund, with primary dealers, and with brokers. And for brokers, there is a restriction, 5% of the total business in a year for individual broker. That means individual broker, you can give only maximum 5% of the total business the bank has done in a particular year. That is a restriction. Questions can be asked on that. What is the limit for broker? So remember, exposure ceiling is the limit fixed by each bank's board with the counterparties, means to whom the treasury is dealing in. The treasury is dealing with other banks, other financial institutions, primary dealers, mutual fund, and brokers. So there are certain limits. They cannot go beyond that amount. Then next is internal control. That means fixing of trading limits, a daylight limit, overnight limit, then stop loss limit, deal size limit, all this open position. So these are all the limits fixed by individual banks management to prevent the impact of or to happening of the risk. So suppose a dealer would like to, a dealer say today afternoon, the rate will be moving up. So let me buy in bulk. But then there is a restriction, how much he can go in between. That is the daylight limit. So he cannot have an open position exceeding the daylight limit. If the daylight limit is 1 lakh, they cannot have a difference, an open position exceeding 1 lakh. If they exceed the open position of 1 lakh, then the dealer will be held responsible. Why you have exceeded? If the bank attains a profit, then he will be uploaded. He will be say, the management will pat at the shoulder and say, well done. But if there is a loss to the bank, naturally he will be held responsible, and that will be recovered from that member who is responsible for the loss. Therefore, the dealer has to be very careful in doing the transaction. They have to transact, they have to operate within the permitted limit allowed by the individual bank. Now, again, these are all the major risks. You have learned risk, different types of risk in risk management, as well as in our foreign exchange division also, in international banking also. But these are the major market risks. One is the liquidity risk, another interest rate risk, and third is currency risk. So what is liquidity risk? Everybody must be knowing. It is the mismatch in cash inflow and outflow. So what is the total inflow of cash and what is the total outflow of cash? And if there is a mismatch, we call it there is a liquidity risk. If the inflow is more than outflow, what happens? Again, there is a liquidity risk. Inflow is more. A bank, a particular day or in a period, say in a month, their inflow is 100 crore and their outflow is only 40 crore or 50 crore. So the remaining 50 crore is remaining there that the bank is keeping as liquid form, as in cash, without earning any interest. So that will be a loss to the bank. That is one way. The liquidity is positive, but there is a mismatch. And what is the other mismatch? Inflow is less and outflow is more. That means the money which you have received in a particular period is 100 crore, but the outflow is 120 crore. That means you require 120 crore to meet your commitments. When the depositor comes, you give me my deposit back, you will have to pay them. If there is sufficient liquidity is not there, can you tell the depositor, you come after 1 month, then the bank's image will be damaged. There comes the run on a bank. It means the depositor will flash the message. See, this particular bank is unable to give me my deposit back. So that message will be spread everywhere, and all the investors, all the depositors will form a queue demanding their money. That is called a run on a bank. So that if an institution, a financial institution, especially a bank, faces a run on a bank, means that their image is lost. Then nobody else will subsequently, they will not come and deposit in that particular bank. Then that bank has to wind up their operation. So that no bank can tolerate. You must be hearing it now. Nowadays, so many issues are there. Yes Bank had have some problem. Then recently, Lakshmi Vilas Bank or some bank had some liquidity problem, and so RBI may impose certain restrictions, moratorium, something like that. It happens because of so many reasons. It happens because maybe mismanagement or deficiency in their internal control. It might have happened. We don't know the exact reason, but if the run on a bank cannot afford to have a run on a bank. Then the bank's image will be lost. Then next is interest rate risk. What is interest rate risk? There is an adverse movement of interest rate. See, as a bank, we are dealing in two. See, bank is getting the deposit and we have to pay interest on that. At the same time, bank is disbursing loan and we collect interest from the borrowers. So we are getting interest for our asset and we are paying interest for our liability. So therefore, if there is a fall in interest earning, then there is an element of interest rate risk. That means our asset is yielding lesser interest and our liability is fetching higher interest. We have an interest rate risk. There is a fall in interest rate earnings. That is called then again, if that interest rate risk is there, it will transform to liquidity risk, or liquidity risk transform to interest rate risk, because how it is, they are the two sides of a coin. Suppose a bank is facing a liquidity risk. That means they are short of liquid cash. So what they will do, they will go to the market and borrow. See, when they go to the market, all the participants in the market, they are hearing the news. The message now in no time it flashed. The TV, if some bank is having some problem, immediately in the news channel, they will scroll a message. Then that flash and everybody will be aware of it. So a particular bank is facing a liquidity crunch. That will be known to all the participants. And whenever they go to the market, to the interbank market, and request, I want 100 crore loan, then naturally the person who is having fund, they will raise the interest rate. If the ruling rate is say 4% or 5% in the call money market, they will say, if you want, you give me 7% or 6%. Like that, then it transforms to interest rates, because you have to, because the bank has to borrow at a higher rate of interest. Then again, it will lead to interest rate risk. So that's what we call interest rate risk and liquidity risk are two sides of a coin. If there is a liquidity risk, it transforms to interest rate risk. And if there is an interest rate risk, it transforms to liquidity risk. Then currency risk. What is currency risk? Exchange risk. One and the same thing. Adverse movement of the value of the currency. So interest rate is the domestic cost of currency and the exchange rate is the external cost of currency. You can also define in that way. Next, we will move on to how do we measure the risk? How do we measure the risk? There are few methods. One is duration, another is VAR. VAR means VAR. We write like this. You might have learned in your risk management. Value at risk. V and R capital and A small. This is the way in which we write VAR. So VAR is value at risk. What is the definition? The definition says VAR is a statistical tool to measure the risk over a given period of time at a defined confidence level under normal market conditions. So this is the definition, one sentence definition of VAR. So what is it? If you split it up, you can have 4 sentences. It's a statistical tool to measure the risk. So what is VAR? It's a statistical tool to measure VAR. That means it's a statistical tool, means it is not exact. It's only a prediction. Because statistics, you must be knowing, when in the morning, there will be a weathercast. There may be a heavy rain today, but sometimes there will not be any rain at all. It happens. Now, recently there was some message by the weather department, and nothing happened here because of cyclone or something like that they were telling. So this is it's only a prediction, and sometimes it happens, sometimes it never happens. So this is a statistical tool, and the chances of becoming correct is depending upon the situation. So we could say it's a statistical tool. Number 2, this is calculated over a period of time. So means VAR will be either overnight VAR will say, or 1 month VAR, 30 days VAR will say, or 7-day VAR will say, or 2 month VAR, or 1 week, like that will say. So there will be a definite period, a defined period, a given period of time. And third, it is at a defined confidence level. What is the confidence level? Confidence level indicates how far this will be correct. So 90% confidence level means the chances of the prediction going correct is 90%. That means there can be a 10% chance of the wrong. And 95% means 95% it will be true. And there's a chance of 5% going wrong. 98 means 98% it can happen, but there is 2% chance of going wrong. And 99%, again, there is 1%. You are going to appear the exam next Sunday on 26th. And what is the chance of winning the exam? Can you say it is 100%? You cannot say. But if you are confident, you can say 99% I will pass. Or somebody will say I will pass 98, but leaving 2% of chance of losing the exam. That is the confidence level. And next, it is about the market under normal market condition. So there is the market risk under normal market condition. That means a war is measured, subsequently the pandemic has spread, COVID-19, that the prediction may be going wrong. So under normal condition, if the things are happening in the normal condition, then the measure may be almost correct. So this is VAR. VAR means value at risk. Value at risk is a measure of risk, to measure the risk. It's a tool to measure the risk. Now, I've given some 1 or 2, 3 examples. Overnight VAR of Euro INR at 99% confidence level is 20 paise. And today's spot buying rate Euro INR is Indian rupee 8 to 30. What does this indicate? So today's buying rate of euro in terms of INR is 82.30. That means on euro, if a customer is going to the bank with euro, the bank buys it at 82.30. And the overnight VAR of the currency of euro at 99% confidence level is 20 paise. That means tomorrow, what will be the buying rate of euro? The spot buying rate of euro tomorrow, as per this measure, this VAR says for 99% accuracy, the VAR is 20 paise. That means this 82.30 of today's rate can be maximum 82.30 plus 20 means 82.50, or 82.30 minus 20 means 82.10. So the next days, the value of euro comes between or ranges between 82.10 and 82.50. This is what VAR. And here again, this is with 99% accuracy. That means there is an 1% of chance that this prediction may go wrong. I think it is clear. So 99% confidence level, the VAR is 20 paise means next day, the value of euro will be either today's rate plus 20 paise or today's rate minus 20 paise. If it is today's rate plus 20, today's rate plus 20 paise means 82.30 plus 20 becomes 82.50. If it is less means it is 82.10. I have given another example. 1 month VAR for a stock at 95% confidence level is rupees 25. And presently the stock is trading at rupees 400. What does this indicate? This indicates during the next 1 month period, the value of this stock means this share, the value of this share can be either goes up to 400 plus 25, 425, or it can come down from 400 to 375, 400 minus 25 with 95% accuracy. This is what VAR. Given another example, see VAR for USD INR at 95% confidence level is 50 basis point overnight. If the day closes at 72 for USD, what is the worst possible rate the next day for an exporter and for an importer? Such a question also they may ask. What is the difference between an exporter and an importer? For an exporter, he is selling currency to the bank. Exporter is bringing currency and the bank is buying it. So the bank will apply the buying rate. So as far as the exporter is concerned, he should get the maximum amount. So if today it is 72 and the VAR overnight is 50 basis points. So 50 basis points means 50.5% because 100 basis point is 1%. So 50 basis point means 0.5%. It is not 50 paise, BPS. If it is PS, it is paise. Earlier question it was paise, but here it is not paise. Yes.
Sir, now we are buying, no, sir. Exporter we are buying. If nostro account is not only dealt, it is always bills buying only, no, sir.
Yes.
Okay. Okay.
Now you both don't bother about the TT buying and bills buying. I think this TT buying and bills buying is roaming in your head and you're breaking. I think it is breaking your head. You forget about those things. Now see,
Okay.
look at an exporter means bank is buying or the customer is selling. Okay, so here the question is, what is the worst possible situation for an exporter? So what's the worst possible or what is the maximum risk they can take means when they bring the currency to the customer, to the bank, he should get the maximum amount. So today it is 72 rupees and the VAR is 50 basis points. So 50 basis point means 0.5% of 72. What is the 0.5% of 72? It is coming to 36 paise. Am I correct? 36 paise. Therefore, tomorrow, the maximum, the rate will go up by 36 paise or the rate will come down by 36 paise. If the rate goes up by 36 paise, it will be 72 plus 36. So 72.36. If it is coming down, it will be 71.64. Now for an exporter, what is the risk? Means he is getting less amount or he is incurring a loss. That is risk. Suppose the rate is going up, whether there is any risk for the exporter, he is getting more. So for an exporter, the risk is maximum, he will get 71.64. And what is for an importer? Importer is going to the bank, he wanted to buy it and the bank is going to sell it. And today the rate is 72. Tomorrow, if moves up by 72.36, then the importer has to pay per dollar 72.36. So for an importer, the rate, if the rate goes up, it is a risk. For an exporter, if the rate comes down, it is a risk. So such type of questions they will ask. I think it's clear. Can I move to the next slide? Or you want a little more explanation on this?
So in this 99% or 95%, where we are using this?
Question they are giving, no?
In this one, we are not using. Subsequent question I will be given 95% for each. If you are asked to compute the VAR, then they will give the confidence level, and there it applies. So we'll come to that. Now here, what does the question says? 95% this prediction can be correct, and there is 5% wrong. So the question says in 95% confidence level, there is 50 basis point overnight. That means the rate can move up or come down by 0.5%. So don't misunderstand, this 50 basis point is not 50 paise. 50 basis points means 0.5%, because 100 basis point is 1%. So 50 basis point is 0.5%. So you have to calculate 0.5% of 72, and you add and subtract. And you look at the exporter's angle and importer's angle, and what is the loss or additional profit they are generating, that you have to look into. Now here comes the question which you asked, we will make use of here. So there are three methods of computation of VAR. So you can calculate VAR using three methods. One is the parametric approach, second is the Monte Carlo simulation, and third is use of historical data. As far as your exam is concerned, the numerical may be asked from parametric approach only. And for Monte Carlo simulation and use of historical data, problems will not be asked. But you should know the three methods, because sometimes they will put a question, which of the following is not a method for computing VAR? Then you should know what are the methods for computing VAR, means for calculation of VAR. So these are the three methods. One is parametric approach, second is Monte Carlo simulation method, and third is use of historical data. Come to the parametric approach. Parametric approach is also called the correlation approach or variance covariance approach. So under this method, what we do, the probable loss is measured using the price sensitivity of the asset concerned. Here, VAR, there is a formula. VAR is derived from the statistical formula W into V into Z, where W stands for the value, V stands for the volatility, means the variation, and Z stands for the standard normal variable. Here comes 90%, 95%, 98%, 99%. For each confidence level, the value of Z changes. This normally they will be given it, they will give it in the question. If it is not given, you have to by heart it. So 95, if the question it is said, what to compute VAR at 90% confidence level means, it is understood that the value of Z is 1.645. 95% it is 1.96. 98% it is 2.326, and 99% confidence level, the value of Z is 2.576. Z means it's a standard normal variable, that bell curve. You might have studied in your business maths that a curve just like in the form of a bell, that is standard normal distribution. Or you don't break your head on those things. Now you just understand, just to learn how to calculate VAR under parametric approach. It's a very simple formula, W into V into Z, where W stands for the value. If you are looking at the currency, it is the value. If the problem is on the equity or security, then it is the value of the security. And V, the volatility, means how the price is changing. And Z is the standard normal variable. Everything will be given to you. We'll do a question in the next slide. And next is, then another formula is here. So VAR formula is there. The next is longer period VAR. That means you will be given overnight VAR. You have to, you have been asked to find what is the 1 week VAR, or what is the VAR for 30 days or 2 months, like that they may ask. So the formula is longer period VAR is equal to overnight VAR into square root of N, where N is the period in days. That means if you are asked to find 7 days VAR, what you have to do? You calculate overnight VAR will be given, overnight VAR into square root of 7. If it is 1 month VAR, it is overnight VAR into square root of 30. If it is 2 month VAR, overnight VAR into square root of 60, and so on. Similarly, overnight war, if longer period war is given, how do you calculate overnight war? Same formula. Overnight war is equal to longer period war divided by square root of n. Same formula you can use. Then Monte Carlo simulation, here what happens is a lot of situations will be simulated and they study it, the impact, and they arrive at a decision. That is simulation method, Monte Carlo simulation. Monte Carlo economists have devised this method. Therefore, it is called Monte Carlo simulation method. Under this method, a number of situations are generated at random and its impact is studied. Then use of historical data, it is the data prevailing over a period is obtained to arrive at a probable loss. That means, suppose they are studying the value of gold. What they will do? They will take the historical data. What happens to the value of gold in the previous, say, 1 year or 2 years? So they make it in the time series and look at when the value is going up, when it is coming down. And depending upon that, they arrive at a conclusion. That is use of historical data. So these are all the 3 methods of computation of war value at risk. One is parametric approach. The formula is W into V into Z. Next is Monte Carlo simulation. Numericals will not be asked. You just learn the method. What is the method? And in this method, how do they calculate the risk? They arrive at the risk by generating random situations. Means they make some simulation, and based on that they study and they have a final measure. That is called that method is known as Monte Carlo simulation. And use of historical data means using the time series. They will study the movement of whether it is the value of gold or the value of US. Suppose it is they are making a war for the value of US dollar. Then what they will do for the past, say, 1 week or past 1 month or 6 months, they will learn how the rate is fluctuating. Then based on that, they are, and tomorrow what will be the rate, or in 7 days time, where the value of dollar ends in. So these are all approximation, and it need not be exact also. So now we'll go to a numeric problem. There is a bank XYZ, which has an investment of 1 crore in equity of a company. The daily volatility of the value of stock is 2%. Compute war at 99% confidence level for the following period: overnight war, weekly war, and monthly war. Now they have given the value of Z as 2.576. Probably they will give it in the question. Sometimes it is not given, means you have to by heart it, no other way. So here you have to calculate the war. Now there is a simple formula. War is W into V into Z. What is W? The value. Here what is the value? 1 crore. So W is 1 crore. And next is volatility. What is the volatility? They have given the daily volatility of the stock is 2%. 2% means 2%, it can go up and down. So 2% means 2 by 100, 0.02. So the value of V is 0.02. Then Z. Here it is given, you have to calculate the war at 99%. So the value of Z is 2.576 given. So 1 crore into 0.02 into 2.576 is rupees 5,15,200. This is overnight war. So 5,15,200, this is overnight war. The first question, the answer is 5,15,200. What does this mean? If today the value of the investment of this particular bank is 1 crore, tomorrow if the value of the investment of 1 crore may be up by 5,15,200 or down by 5,15,200. That is the meaning of this war. Now next question B is weekly, find weekly war. So what is the formula for weekly war? You have calculated the monthly war, so overnight war. And for weekly war, it is overnight war into square root of the days. Therefore here overnight war is 5,15,200 and then multiply with root of 7. And root of 7 is 2.65. You will get the answer as 13,65,280. That means if today the value of the security is 1 crore, over a period of next 7 days, the value of the security may be up by 13,65,280, or it may be decreased by 13,65,280. That's the meaning. Third is, what is the monthly war? So monthly war, you can take the days as 30 days. Here again, overnight war into square root of 30. Overnight war, 5,15,200. Square root of 30 is 5.48. Multiply, you will get 28 lakh 23,296. So this is the way in which you can compute war using the parametric approach. I think it's a very simple one. Probably this was a recent addition in the syllabus. So they may ask a question on this. Earlier, this computation was not there. Next, we'll move on to bond. You might have studied a bond in JAIIB as well as in
the
your
monthly value we can take for any cases we can take 30.
In any monthly you can take n as 30. 2 months you can multiply. 2 months means 60. 3 months means 90 days. Like that you can take.
Okay.
Now we'll move on to the bonds. Is it familiar to all of you?
Yearly 350 only.
Anybody is hearing it for the first time? I want, if somebody this is hearing for the first time, I have to give little more importance. Otherwise, I will go in a faster way. I think it is familiar. No. Okay. See, what is a bond? It's a debt instrument. And this can be issued by a government or a private firm. Earlier, the concept of bond, when we say it's a bond, means we will feel that it's a government bond. Now that is changed. Even private firm, well-rated companies, public sector undertaking, and private companies, they can also come out with a bond. And it's a debt instrument. If a firm would like to have fund from the public, raise fundraising, they will issue a bond. That's all. It's a debt instrument. And here, another terminology we come across is coupon. Coupon means it's nothing but the interest payable on the bond. So in bond theory, in bond topic bond, coupon means nothing but interest. Then face value, it is the issue price of the bond, that is par value or face value. Then every bond will have a maturity, and the maturity will be either 3 year or 5 year or 6 year or 10 year, like that. So that is a maturity. Means when a firm is a government or a firm, corporate is issuing a bond, they have to mention a period. It can be 5 years. That means they are borrowing the money from the public for a period of 5 years. And on maturity, they will give back the money. The next is the redemption value. Redemption value means what is the value they get on maturity. Sometimes in the question they will be given, the bond is redeemable at a premium. That means if the face value is 100 rupees and it is redeemable at a premium of 5%, means on maturity, they will give, instead of 100, they will give 105. At the same time, it can be redeemed at a discount also. If it is at a discount, suppose there is a face value is 1,000 rupees, and they will say that this is redeemable on maturity at a discount of 10%, means on maturity, the company will give not 1,000 rupees, they will give only 900 rupees because 10% discount, 10% of 1,000 is 100 rupees. Next is market value. What is market value? Market value, this is the peculiarity of the bond, because suppose somebody invested in a bond, they can trade it in the market. Suppose you invested 1 lakh rupees in a bank and bank gives you a fixed deposit receipt. Can you trade it in the market? No. You have to go to the bank and ask for the money prematurely. But in the case of a bond, suppose a company issue a bond for a period of 3 years and you have invested in this bond. And after some time, suppose you need money. You cannot go to the company and claim the money because company had taken the money for a period of 3 years. So before that, the company is not liable to pay you the money, even though you are invested, because as per the terms of the bond details furnished given in the brochure, the company had said, you give me, we issue the bond for a period of 3 years. Means on maturity only, the company is liable to pay the money. So if before the due date, if the investor would like to have the money, what they can do? They can go to the market, the stock market, and there they can sell it. So there will be people who want to buy it, they buy it. And there, at what value this bond is traded, we call it the market value. So the market value can be above the face value or it can be below the face value. If the market value is above the face value, we call the bond is traded at a premium. And if the market value is below the face value, we'll say the bond is traded at a discount. For example, there is a 100 rupee bond. And if you want to sell, you are holding it, you're going to the market, you want the money. You will say, go to the stock market, see, I am having this company's bond, so much bond, the face value is 100 rupees at what you can buy. So every investors who are interested in, they will quote different rates. And somebody quotes, say, I will give you 95. Somebody says, I will give you 98. And another person say, no, I will give you 101. You will give to the person who has bidded the highest. So you will give to the person who had quoted 101. Then you can say that the bond is traded at a premium of 1 rupee. Suppose you have...
Sir, why he will buy with 101 rupees? Sir?
Pardon?
Why he will buy with 101 rupees? Sir?
We'll discuss. See, now, see, we are going to learn it. Why he buys, I'll come to you. See, because this is the beginning only. Just okay. We are just started walking, and in between we'll fall. After some time, you can walk freely. Next is market value. So this is market value. So the only thing is you should understand what is market value. Market value is the value at which this is traded in the market. Then yield to maturity. What is YTM? This is the yield to the investor who holds it till maturity. Next is duration. What is duration? Holding period of the bond for break even. That means if somebody is holding the bond for a certain period, the interest rate risk is not affected till the duration, up to duration. Suppose if the duration of a bond is 2 years, that means if you hold the bond for 2 years and then dispose it off, he will not have any interest rate risk. That means whatever be the fluctuation happening in the market is not affected if you dispose it off at the duration. That means if the duration is 2.5, when it completes 2.5 years, you have to dispose it off. So duration is nothing but the holding period of the bond for break even, or it is the holding period for which the investor is not affected by the movement in the interest rate in the market. And modified duration, what is it? It's a direct method to measure the price sensitivity of a bond. That means how the value of a bond fluctuates when there is a change in the interest rate. So modified duration is a measure to find the price sensitivity when there is a change in the yield. So these are all the major terms we use. Now you look at how a bond works. There is a bond of ₹100, coupon rate 8%. Its period is 4 years. So a company A issue this bond. Face value is 100 rupees, coupon rate is 8%, and the period is 4 years. If somebody invests in this bond, they purchase this bond, how does he get the money? The cash flow here it is, on completion of first year, the company pays the investor a return of 8%. That is coupon rate, means an interest of 8%. What is 8% of 100 rupees? ₹8. So at the end of first year, the company pays a coupon of 8 rupees. Again, at the end of second year, the company pays a coupon of 8 rupees. Third year, 8 rupees. And at the end of fourth year, the company gives 100 rupees, the invested amount, plus the fourth year coupon of 8 rupees, 108 rupees. This is the way in which the investor gets the money back. Now look at the same example where the coupon is paid semi-annually. That means semi-annually means half yearly. So here, this particular case, the company is paying not every year, they are making the payment every half year. And the period is 4 years, coupon rate is 8%, face value is 100. So at the end of first half year, means on completion of 6 months, the company pays 8% of 100 rupees. 8% of 100 rupees applicable for 6 months. So what you have to do? You have to divide the rate by 2. If it is half yearly, because we have learned in interest calculation, no? If it is semi-annually or half yearly, divide the rate by 2. So instead of 8%, it becomes 4%. So first half year means on completion of 6 months, the company pays 4 rupees. Again, completion of another 6 months means completion of the first year, 4 rupees. Then third half year, 4 rupees. Fourth half year, 4 rupees. Like that, seventh half year, 4 rupees. And on the eighth half year, the company pays back 100 plus 4. This is the way in which the repayment is made by the company to the investor. I think it's clear. One more point I would like to mention. Suppose while issuing this bond, the issuing company, make a comment in the brochure. They say that this bond is redeemable at a premium of 10%. Suppose they have mentioned it. Then at the end of fourth year or at the end of eighth half year, the company pays the face value of 100 rupees. plus a premium of 10% means 10 rupees. So 100 plus 10 plus the coupon amount of 8 rupees in the case of yearly. So that means the company pays at the end of 4th year 118. 100 plus the face 100 the face value, 10 rupees the premium, and 8 rupees the coupon. If it is half yearly, and at the end of the 8th half year, the company pays 100 rupees plus 10 rupees coupon 110 plus 4 rupees, 10 rupees premium, 110 plus 4 rupees, 114. The company says this is redeemable at a discount of 10%. On maturity on the 4th year, instead of 100 rupees, the company pays only 90. 90 plus the coupon, so 98. In the other case, it is 90 plus 4, 94. I think it's clear. We'll move on to the next one. Duration, I told you, some formulas are here and some important points to remember. Duration is the holding period for the bond to break even. It's the holding period at the end of which the holder is not affected by the interest rate risk. Then duration of a zero coupon bond is its maturity. Frequently they ask a question. There is a zero coupon bond and the leftover period is 5 years. What is its duration? What is meant by a zero coupon bond? A zero coupon bond is a bond where there is no coupon payment. Suppose a company issue a zero coupon bond with face value 1,000, then they will issue it at a discount. So a zero coupon bond, face value 1,000, they issue at a price of say 950 rupees. And the life is 5 years. That means if somebody wanted to invest, they buy this bond. Per bond, they have to pay 950 rupees. Hold it for the whole entire period of 5 years. And the company, on surrendering, the company will give 1,000 rupees. There is no coupon payment in between. Such a bond is called a zero coupon bond. So in the case of a zero coupon bond, the duration is its maturity. Make it its duration is its maturity. How many years left over? That is the duration. Then for a longer the duration, greater is the price sensitivity of the bond. So if the duration is more, price sensitivity is also more. And duration and YTM are inversely related. That means yield and duration are inversely related. If one is high, the other will be lower. If duration is higher, YTM will be less. If YTM is less, YTM is high, duration will be less. So they move in opposite direction or they are inversely related. Another